Welcome to Safe Simple Sound Podcast. I am your host, PK. Today we have an exciting episode lined up where we use AI voices to bring insightful discussions to life. But before we dive in, please note this podcast is for entertainment and educational purposes only and does not constitute financial, legal, or professional advice. Investment decisions should always consider your personal circumstances, financial goals, and risk tolerance. Be sure to consult a qualified financial professional before making any investment decisions. If you would like personalized guidance, you can reach out to me at savesimplesound.com/contact. Now, let's get started.
Hey everyone, this is Alex. Welcome back to Safe Simple Sound. Today, we're diving into the often overlooked yet incredibly important world of tax efficient investing. Today's episode is based on a great article titled Tax Efficient Investing Maximizing Your Returns Through Smart Tax Management on SafeSimpleSound.com website. It really underscores the C and the U in our secured approach. Create a financial safety net and understand financial choices. After all, what good is growing your wealth if you're losing a big chunk of it to Uncle Sam? This article highlights how smart tax management can significantly boost your long-term returns. We'll be focusing on a few key takeaways: strategic account selection, the power of tax loss harvesting, and choosing the right investment vehicles. These strategies aren't just about minimizing taxes. They're about understanding your financial choices and making your money work harder for you. Embracing that R in secured, reaping the benefits of compound growth. So, how are we going to break this down? First, we'll explore strategic account selection. We'll look at two scenarios: a young professional just starting out and a high-income earner nearing retirement, demonstrating how their needs and account strategies differ. Then, we'll tackle tax loss harvesting, examining how to capitalize on market downturns and offset gains from things like a real estate sale. This ties directly into our E in secured, embracing financial flexibility, as we learn how to adapt to changing market conditions. Finally, we'll discuss investment vehicle selection, comparing ETFs versus mutual funds, and exploring the potential benefits of municipal bonds. Get ready for a practical, actionable episode that will empower you to make tax-smart investment decisions, build a stronger financial safety net, and ultimately develop lasting wealth, truly embodying the safe, simple, and sound approach. Let's dive in. Imagine, Taylor, you're in your late 20s, earning a good income and contributing regularly to your 401k. You've also opened a Roth IRA and a taxable brokerage account, but you're not quite sure how to best utilize all three. This is a great position to be in, but it can also feel a bit overwhelming. Sam, can you help us unpack this? Given this long time horizon, what asset allocation strategy should Taylor prioritize in each account type: the 401k, Roth IRA, and taxable brokerage?
Great question, Alex. For someone in their 20s, a higher tolerance for risk is generally advisable, meaning a larger allocation to stocks. However, where those stocks are held matters from a tax perspective.
So, even though I'm aiming for mostly stocks across the board, the specific types of stocks I hold in each account should be different.
Exactly. Think of it this way. Your Roth IRA is your tax-sheltered growth engine. Because qualified withdrawals are tax-free in retirement, you want to prioritize investments with the highest potential for growth, such as stocks, particularly those that might generate higher dividends down the line. These dividends can grow tax-free within the Roth.
That's a crucial point. It's not just about growth, it's about tax-free growth. So Sam, how can Taylor maximize tax advantages by placing specific investments in the right accounts? Where do the 401k and taxable brokerage fit into this strategy?
Your 401k is also tax-advantaged, but in a different way. Contributions are often tax-deductible, and growth is tax-deferred. This makes it a good place for investments that would normally generate higher taxes. Think actively managed funds with high turnover, which can trigger more capital gains taxes.
Short-term gains are taxed as ordinary income, right? So holding those high turnover funds in a 401k shields me from those taxes until retirement.
Precisely. Now, your taxable brokerage account is where you hold investments you intend to keep long-term and that are relatively tax efficient. Things like index funds, ETFs, or individual stocks where you're aiming for long-term capital gains. These are taxed at a lower rate than your ordinary income.
So to recap, high growth, potentially high dividend stocks in the Roth IRA, things like high turnover funds in the 401k, and long-term tax-efficient holdings in the taxable brokerage. It's like organizing your pantry, putting things where they best belong.
So if I understand correctly, by strategically placing my investments, I'm essentially minimizing my current tax bill and maximizing tax-free growth for the future.
Absolutely. It's about playing the long game.
That's a fantastic overview, Sam. The key takeaway here is that strategic account selection isn't about picking individual stocks. It's about understanding the tax implications of each account type and using them to your advantage. For our listeners, analyze your current investment accounts and consider their tax implications. Don't hesitate to consult a financial advisor for personalized advice. This is one area where a little planning can make a significant difference in your long-term returns. So Taylor, we just discussed how a young professional starting out can maximize their tax advantages by strategically allocating assets across different account types. Now let's shift gears and consider a different stage of life, retirement. In this scenario, we're focusing on a high-income earner nearing retirement. They have substantial assets in both taxable and tax-advantaged accounts, like 401k and traditional IRAs. They're looking to optimize their portfolio for tax efficiency as they prepare for withdrawals. This is a critical point in their financial journey, as smart tax planning now can significantly impact their income stream during retirement. Sam, for someone in this position, what are some key strategies they can use to minimize taxes on their withdrawals?
Retirement income is a complex topic, and we'll do a full series of episodes focused just on this topic, but we can briefly discuss it in this episode. When it comes to retirement income, strategic account selection is paramount. Remember, withdrawals from traditional IRAs and 401k are taxed as ordinary income. However, qualified withdrawals from Roth accounts are tax-free.
So, if I understand correctly, this high-income earner should prioritize withdrawing from their Roth accounts first.
Not always. It depends on the situation. Given the ramifications of decisions at this stage, contacting financial advisor is best. They will show you different options and their pros and cons. For some, using Roth is best, and for some, exhausting 401k first is better. There is no one-size-fits-all in this case.
That's a great point, Sam. Taylor, you mentioned Roth accounts. This brings me to my second question. Should someone in this situation consider converting some of their traditional IRA assets to a Roth IRA?
That sounds interesting, but wouldn't that conversion trigger taxes now?
Yes, you're right. Converting from a traditional IRA to a Roth IRA does trigger taxes in the year of conversion. However, for someone nearing retirement, it can be a smart move. They might be in a lower tax bracket now compared to when they begin taking larger withdrawals in retirement, especially if they anticipate higher income from required minimum distributions.
That's an important distinction. Think of it like paying a smaller toll now to avoid a much larger one later. Sam, are there any specific investment types that are particularly beneficial to hold in taxable versus tax-advantaged accounts for someone approaching retirement?
Absolutely. In taxable accounts, they should prioritize tax-efficient investments like municipal bonds, which offer tax-free income, and ETFs, which are known for their low turnover and thus fewer capital gains distributions. For tax-advantaged accounts, holdings like high-yield bonds and REITs are suitable as the taxes on their dividends and distributions are deferred.
This reminds me of what we discussed about asset location in the previous episode. It's about placing certain asset types in specific account types to optimize tax efficiency based on how they're taxed. So in this case, you're strategically putting investments that are likely to generate higher, more frequent taxable events within tax-advantaged accounts, right?
Precisely. It's about minimizing the tax drag on your overall portfolio.
Let's quickly recap. We talked about prioritizing withdrawals from Roth or 401k accounts first, then strategic withdrawals from taxable accounts, taking into account capital gains rates. We also discussed the potential benefits of Roth conversions for some nearing retirement and the importance of asset location. If you're nearing retirement, review your portfolio for tax efficiency opportunities. Consider working with a tax professional to develop a tailored withdrawal strategy that considers your specific financial situation and goals. So, we've just discussed how someone nearing retirement might optimize their accounts for tax efficiency. But what about those of us who are further from retirement and facing a market downturn? Let's shift gears and talk about tax loss harvesting, a strategy that can be especially valuable during times like these. Our next scenario focuses on an investor who, unfortunately, is experiencing significant losses in their portfolio due to a market downturn. They're understandably concerned and want to know how they can use tax loss harvesting to potentially offset gains and reduce their tax burden. Sam, Taylor, any initial thoughts on this? Specifically, I'm curious, Sam, how can this investor identify tax loss harvesting opportunities in their portfolio?
It starts with reviewing your investment holdings. Look for investments that are currently valued lower than what you originally paid for them. These represent potential tax loss harvesting opportunities. Remember, we are talking about realized losses, meaning you have to sell the investment to lock in the loss. Simply being down on paper doesn't allow you to harvest the loss.
So, if I understand correctly, if I bought stock A for $100 and now it's worth $75, I have a $25 potential loss that I could harvest. But if I just hold on to it, hoping it goes back up, I can't use that loss for tax purposes yet.
Precisely, you have to sell to realize the loss.
Excellent. Now, Sam, let's talk about the potential downsides. What are the risks and limitations of tax loss harvesting, specifically regarding wash sales?
The biggest pitfall is the wash sale rule. This rule prevents you from claiming a loss if you repurchase the same or a substantially identical security within 30 days before or after the sale. So if you sell stock A at a loss and then buy it back a week later, you can't claim that loss.
Okay, so the key is to wait at least 31 days before repurchasing the same stock, right? This reminds me of what we discussed earlier about holding time optimization. It plays a similar role, but in a different context. But what counts as substantially identical? Does it just apply to the exact same stock, or are there other considerations?
Good question, Taylor. It's not always straightforward. While buying the exact same stock is a clear wash sale, substantially identical can also extend to very similar investments, like shares in another company in the same sector with a nearly identical business model. You need to be careful and perhaps consult a financial professional to avoid inadvertently triggering a wash sale.
That's a great point, Sam. Let me offer an example. Imagine you sell shares of a large cap tech company at a loss and then buy shares of another large cap tech company with a similar product line and market share. That could be considered a wash sale even if it isn't the exact same stock.
So if I understand this correctly, I could potentially buy a similar but not identical ETF in the same sector. Let's say I sell an S&P 500 index ETF at a loss. Could I buy a total stock market index ETF during that 30-day window?
That's a good example of navigating the wash sale rule strategically. While both are broad market index ETFs, they aren't substantially identical. The total stock market index includes small and mid-cap companies that the S&P 500 doesn't. This approach lets you maintain market exposure while still realizing the tax loss.
So to recap, tax loss harvesting can be a valuable tool during market downturns. Identify investments that are down, sell them to realize the loss, but be mindful of the wash sale rule. Don't repurchase substantially identical securities within 30 days. And as always, consider consulting with a tax professional for personalized advice. Remember to review your portfolio regularly, especially during market downturns, for potential tax loss harvesting opportunities. So, Taylor, we just discussed how a market downturn can present opportunities for tax loss harvesting. But what about when you have a big win, like selling a property? That's what we'll explore now. Let's say you've just sold a piece of real estate and made a substantial profit. Congratulations. But now you're facing a potentially hefty capital gains tax bill. This is where tax loss harvesting can become a powerful tool, even in a profitable scenario. Sam, can you walk us through this? Specifically, what strategies can this investor employ to minimize the tax impact of the real estate sale? And how can they effectively coordinate tax loss harvesting with their overall financial plan?
Absolutely, Alex. Tax loss harvesting can be especially helpful when you have a large capital gain like this. The core idea is to offset that gain with losses realized from selling other investments, like stocks or bonds. Let's say our investor has some stocks in their portfolio that have declined in value. By selling those stocks at a loss, they can reduce their overall taxable income, thereby lessening the tax bite from the real estate sale.
So if I understand correctly, even though they made a profit on the real estate, they can sell some losing stocks to lower the overall amount they'll owe in taxes.
Precisely. The reference article we mentioned earlier talks about offsetting capital gains. That's exactly what we're doing here.
It's like balancing a scale, Taylor. On one side, you have the gains from the real estate sale, and on the other, you're adding losses to bring the overall balance down.
This reminds me of what we discussed about strategic account selection. Does the type of account the stocks are held in matter here?
Excellent question, Taylor. Yes, it does. Ideally, these loss-generating sales would happen in a taxable brokerage account. Losses harvested within tax-advantaged accounts like 401k or IRAs can't be used to offset gains in a taxable account.
A good analogy is thinking of separate buckets. Your taxable brokerage account is one bucket, and your retirement accounts are another. You can't pour water from the retirement bucket into the taxable bucket to lower the water level.
That makes perfect sense. So let's say the investor has enough losses to completely offset the gain. Are there any downsides to this strategy?
The main thing to watch out for is the wash sale rule. This rule prevents you from claiming a loss if you buy back the same or substantially identical security within 30 days of the sale. So if you sell a stock at a loss to offset your gain, you can't just buy it right back the next day.
The IRS isn't going to let you play games with your losses. The intention behind tax loss harvesting is to genuinely realize a loss, not just manipulate the system for a short-term tax benefit.
So if I understand correctly, to effectively use this strategy, you need to be mindful of the wash sale rule and potentially invest in a slightly different but comparable security if you still want market exposure.
Exactly. And as part of their overall financial plan, the investor should be proactively looking for these opportunities, particularly if they anticipate a large capital gain event like a real estate sale in the future.
So to recap, tax loss harvesting can be a very effective tool to offset capital gains, even those from outside your stock portfolio like real estate sales. Remember, the key is to be mindful of the wash sale rule and to coordinate this strategy with your broader financial plan. Sam mentioned looking for these opportunities proactively. This can really make a difference in minimizing your tax burden. Taylor, any final thoughts?
Just that this strategy seems much more nuanced than I initially thought. It's definitely something to discuss with a financial advisor to ensure you're doing it correctly.
Excellent point. And for our listeners, if you anticipate a large capital gain, consult a tax advisor to discuss strategies for minimizing the tax burden, including tax loss harvesting. It can save you a substantial amount of money in the long run. All right, so we've talked about mitigating capital gains through tax loss harvesting. That ties in nicely with our next topic, which focuses on making smart choices from the get-go when it comes to the types of investments you hold. This time, we're looking at a beginner investor trying to decide between ETFs and mutual funds and wondering about the tax implications of each.
I think this is something a lot of new investors grapple with. I remember being totally confused about the difference, let alone the tax implications.
Absolutely, Taylor. It's a common question. Both ETFs and mutual funds are great ways to diversify your portfolio, but they do have different tax characteristics.
Perfect segue, Sam. So let's dive into the first question. What are the key tax differences between ETFs and mutual funds?
The core difference lies in how they are traded and when they realize capital gains. ETFs trade like stocks on an exchange. This means you, the investor, control when you buy and sell, and therefore when you incur capital gains taxes. Mutual funds, on the other hand, are priced once at the end of the trading day. When investors redeem their shares, the fund manager might need to sell underlying assets to meet those redemptions. This can trigger capital gains distributions passed on to all shareholders, even if they haven't sold any of their own shares.
So if I understand correctly, with a mutual fund, I could end up paying taxes on gains even if I didn't sell anything. That seems counterintuitive.
Exactly. It's a common point of confusion. Imagine a mutual fund holding stock XYZ. If a large number of investors decide to cash out, the fund manager might have to sell some of that XYZ stock. If they sell it for a profit, that profit gets distributed as a capital gain to all shareholders, regardless of whether they wanted to sell. ETFs generally avoid this because of their trading mechanism. They create and redeem shares in large blocks with institutional investors, typically in kind, minimizing the need to sell underlying assets to meet regular investor redemptions.
Great explanation, Sam. This reminds me of what we discussed about tax loss harvesting. Knowing this difference can really impact your strategy. So next question. How can an investor determine which vehicle, an ETF or a mutual fund, aligns best with their investment goals and tax situation?
It depends on several factors, including their investment timeline, risk tolerance, and which type of account they're investing in. If someone is investing in a taxable brokerage account and is focused on minimizing capital gains distributions, ETFs are often a more tax-efficient choice.
This brings up something I was wondering about. Our reference article mentioned placing ETFs in taxable accounts and active mutual funds in tax-advantaged accounts. Why is that?
Good question, Taylor. It goes back to those distributions. In a tax-advantaged account like a 401k or traditional IRA, you're not taxed on those capital gains distributions currently. The tax implications come later upon withdrawal. So the potential tax disadvantage of mutual funds is less relevant in these accounts. Conversely, in a taxable account, the tax efficiency of ETFs makes them more attractive.
To summarize, ETFs offer greater control over when you realize capital gains, while mutual funds can trigger capital gains distributions even if you haven't sold your shares. Choosing the right vehicle depends on your individual circumstances and which account type you're using. As a call to action for our listeners, take the time to research the tax efficiency of various investment vehicles before making decisions. It can significantly impact your long-term returns. Don't be afraid to ask questions and seek professional advice if needed. So, Taylor, we've just explored the tax efficiency differences between ETFs and mutual funds. Another investment vehicle that often comes up in conversations about tax-smart investing is municipal bonds. Let's delve into that now. In this scenario, we're focusing on a high-income individual looking to optimize their taxable portfolio. They're specifically interested in understanding the potential tax advantages of municipal bonds. So, Sam, under what circumstances are municipal bonds most advantageous?
Municipal bonds, or munis, shine brightest for those in higher tax brackets. Because the interest income they generate is generally tax-free at the federal level, and sometimes even at the state level if you buy bonds issued in your state, the higher your tax bracket, the greater the comparative advantage over taxable bonds.
So, if I understand correctly, someone who pays a higher percentage of their income in taxes benefits more from the tax-free nature of munis than someone in a lower tax bracket.
Exactly. Imagine two investors, one in the 12% tax bracket and another in the 32% bracket. Both are considering a bond yielding 5%. The investor in the 12% bracket keeps 4.4% after taxes with the taxable bond, not vastly different from the 5% muni. But the 32% bracket investor only keeps 3.4% after taxes with the taxable bond. For them, the muni offers a significantly better after-tax return.
That's a great illustration, Sam. It really highlights the importance of considering your tax bracket when evaluating investment options. Now, our second question. How should an individual compare the after-tax yield of municipal bonds with other investment options?
The key is calculating the tax-equivalent yield. This tells you what yield a taxable bond would need to offer to match the after-tax return of a muni.
Can you walk us through an example of how to calculate that?
Sure. Let's say a municipal bond yields 4%. If you're in the 24% tax bracket, you divide the muni yield by 1 minus your tax rate. In this case, that's 4% divided by 1 minus 24, or 0.76, which equals about 5.26%. That means a taxable bond would need to yield 5.26% to provide the same after-tax return as the 4% muni.
This is where the reference article we mentioned earlier comes in handy. It emphasizes the need to consider not just the headline yield, but the after-tax yield. Taylor, how does this connect with what we discussed earlier about strategic account selection?
This reminds me of the point about placing tax-inefficient investments, like high-yield corporate bonds, in tax-advantaged accounts like 401k and IRAs. It sounds like munis, with their tax advantages, would be more suitable for a taxable brokerage account.
Precisely. Taxable accounts are where the benefits of munis truly shine.
So let's recap. Municipal bonds can be a valuable tool for tax-efficient investing, especially for those in higher tax brackets. Comparing the tax-equivalent yield to the yield of taxable bonds allows for an apples-to-apples comparison. And finally, munis are generally best suited for taxable brokerage accounts. Before we move on, remember to compare the tax-equivalent yield of municipal bonds with other fixed-income options before investing. And that wraps up our deep dive into tax-efficient investing here on Safe, Simple, Sound. We covered a lot of ground today, drawing from that excellent article on maximizing returns through smart tax management. Just like we talked about at the start, it's all about that secured approach. We explored how strategic account selection, remember that young professional just getting started and the retiree looking to optimize their withdrawals, can really make a difference in your long-term returns. We also tackled the ins and outs of tax loss harvesting, emphasizing how it can bring you financial flexibility, especially during market downturns. And finally, we looked at choosing the right investment vehicles, like ETFs versus mutual funds, helping you understand those financial choices we face every day. One of the most impactful discussions for me was around tax loss harvesting to offset a large capital gain, a situation many of us might face someday. Remember, optimizing your taxes isn't about avoiding them altogether. It's about making informed decisions that align with your overall financial goals. It's about making your money work smarter, not harder. Thank you all so much for joining me today. It's a real pleasure sharing these insights with you. Be sure to check out the show notes for links to the article and other resources. Subscribe to Safe, Simple, Sound wherever you get your podcasts, and tell your friends. We love growing our community. In next episode, we'll bring it all together and wrap up the series on stocks, so be sure to tune in for that. Until then, remember to keep it safe, simple, and sound. This is Alex, signing off.
That's all for this episode. If you found it valuable, don't forget to subscribe to the podcast. For more insights, you can join my newsletter at safesimplesound.com. If you would like personalized guidance, you can reach out to us at safesimplesound.com/contact. Until next time, take care and bye for now.